Okay. A note simply is a paper document that represents a debt. And it could be a mortgage, it could be credit cards, it could be an auto loan, it could be a HELOC, it could be lots of different things. We're going to concentrate on mortgage notes on single-family residences. And as we go through this, I'll give you a little bit of my philosophy about why that's a good place to be investing. And although any kind of non-performing note on a strip mall or a commercial or a restaurant or any kind of multifamily, 5 units or more, those all could be invested in as well and made to reperform. Okay? Of course, our focus here is on non-performing, first position, institutional or bank-created real estate. Up until about 5 years ago, 6 years ago, most of the non-performing notes were sold in the secondary market or seller carryback paper. And much of the information you'll see on the internet is from folks who have been in that business for 18, 20 years, talking about how to go out and find Ma and Pa who sold the 20 acres or their homestead for retirement and carried back a mortgage and then later needed cash and then went to sell it. But we're going to be talking about institutional paper, not seller carryback paper. We're going to focus on mortgages and trust deeds. And the differences are the security paper generally in the eastern part of the country is a document called a mortgage. Out here in the west, it's generally called a deed of trust. And we'll define that a little bit more carefully. Okay, the note generally includes a promissory note, which is the IOU the borrower signs with the bank and says, I promise to pay all the money you lent me to buy this house at X% annual interest rate for generally for 360 months, and my monthly payment will be, and defines other loan terms. In the process of working through the life of a loan will get sold. How many people here have a mortgage on their home? Okay. Have you ever gotten a letter from your lender saying you now have a new servicing company, or you have a new company that now owns your loan? Okay. Well, that's what's called a hello or a goodbye letter that says, okay, the old mortgage holder sold it. Then there's a new mortgage holder, and somebody needs to send your money to. Okay, and what that is. So in order, when the note goes from one party to another, we need to record that transaction. So the document that records the transaction of the note, the promissory note, is called an allonge. How many people here write checks or receive checks and cash them? Okay, what do you do when you go to cash a check you received?
Sign the back.
You turn it over and you sign the back. Okay, that's an allonge. That's what you're doing, is you're saying pay to the bank this amount of money. Okay, so that's basically an allonge. That's what you're doing here. Okay, an assignment assigns, which is what it means, assigns the ownership of the mortgage document or the deed of trust to the new owner. And that document is recorded in the county courthouse. So once a borrower borrows money and the mortgage is recorded in the county courthouse, no matter how many times that loan might pass, excuse me, no matter how many times that loan may pass through the hands of a number of different banks or investors, the ownership of that note is recorded in the county courthouse. And that, excuse me, and that's it. There's another way that property gets sold in this country, and it's called a contract for deed or a land contract. And a land contract is a periodic sale. There's another term for it, term sale, where the borrower has possession of the property to live in and pays on the contract every month until the entire amount of what's owed is paid off. And at that point, in the meantime, the ownership of the property is retained by the seller or by the investor. There's no, if in case of default, there is no requirement for foreclosure, retained by the seller. So you keep the deed, you own the property outright. They're paying monthly payments, they're paying down. It's most of them are fully amortized loans. At the end of the period, if they paid it all off on time, then the deed is transferred to the buyer. In the meantime, you own it. If they default, they abandon the property. There's generally some procedures on a state-by-state level that you go through in order to cancel out that contract, and you still own and the possession.
Also, it's important to note that in contract for deeds, often they're higher risk borrowers. So they might have a little bit lower credit score. They might not have as much of a down payment to put down on a property. So generally, they're going to be maybe in a little higher risk area. So keep in mind that the transfer of ownership in a regular, if you buy a house, the transfer of ownership typically happens right then and there, not so much in a contract for deed. So if that borrower does in fact default, there's language in that contract for deed that they will actually turn into a tenant. So then you're just worried about eviction laws. You don't have to go through the whole foreclosure procedure because you as the bank, as the investor, will actually hold the deed until that contract is completely paid in full.
And generally, contract for deeds are, the loan amounts are typically $35,000 up to about $70,000. So they're not very large. Okay.